Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for, and what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. This is Destination Retirement. My name is Robert Kuhn. If you've listened to the show in the past, welcome back. If this is your first time, thank you for joining us. Our job, I think, is to help the smart money get smarter. And that's something that we're very, very focused on. We are SEC registered, so registered investment advisor. We are specializing, if this is your first time, we specialize in tax reduction strategies. Strategies also that can deliver positive returns even in negative markets. The strategies the average advisory firm conveniently ignores because they don't have access to it or they haven't incorporated it in their business. From structured investments offered by the largest banks in the world to strategies like Bison II, the energy strategy, which in 2004, if you were an investor, helped you reduce your taxable income significantly, up to $95,000 per $100,000 invested. 24 was very, very strong. Our portfolios are not passive. We engineer them to win, designed to protect in down markets and grow in up markets. This is, again, exactly what I think most advisors are doing with their own portfolios. And we're doing it at scale for the individual. And so if anything I talk about during the show resonates, piques an interest, you want to learn more about, simply give Paige a call, 630-492-1912, 630-492-1912. So we are headquartered, as you know, now in Oak Brook. We're in the Regency Towers. If you know where the Fidelity office is in Oak Brook, right off of 22nd Street, we are on the 5th floor. And if you come into our office, don't expect a stuffy wealth management office. We love sports. If you want to take a trip down memory lane and look at many signed jerseys from the 85 Bears to some of our 90s Bulls, to some legends of the Chicago Cubs and the Chicago Blackhawks. Almost every square inch is covered with jerseys, signed jerseys and framed jerseys. And so we love it. We think it's great. So if you'd love to come in, we'd love to have you. 630-492-1912. So a lot to get to this week. Obviously, markets keep rip-roaring and going up. And maybe they'll never go down again. I was in Florida on a last-minute vacation this past week for a handful of days, and I listened to a few radio shows. And since they're out of market, I feel like I can talk about them. Certainly won't name any names, but I think it's a pretty consistent theme of what is on the radio today for individual financial advice. So I'm certainly made some notes there that I want to look back on and share with you today. Markets, obviously, you know, it's so counterintuitive, right? Everybody thinks the markets are going to go down. Everyone thinks the markets have to go down. The reality is the markets don't have to do anything. And what you think, what I think, what your friend thinks, what your neighbor thinks is irrelevant. And we all have gut feels. We all have hunches. We all have thoughts. We all think things should do this, should do that. And the reality is that the markets are going to do what the markets are going to do. And the growth in the equity markets obviously has been to some extent historic. The losses in the fixed income market, which is what most traditional advisors, or if you go and meet with one of the big firms that just kind of, do-it-yourselfers, where you meet with a, young, which isn't bad. We all start in the industry somewhere, but you meet with a younger advisor that meets with thousands and thousands of clients, and they have no real vested interest. I don't think they're bad people, but they have no real true vested interest in seeing your portfolio succeed in all markets. they're still using fixed income as a means of diversification, as a means of portfolio stability. And that's a challenge because we're in the worst 5-year period still in the bond market. And so I really encourage you to look at that side of your balance sheet and investment portfolio and see how that's done, because it still amazes me, absolutely amazes me, the interest in the bank notes, enhanced income yield notes, structured notes, call them what you want. They're strategies that are contractually guaranteed by the largest banks in the world, JP Morgan's, Citigroup's, Bank America's, et cetera, et cetera. They are so commonplace. They are so not cutting edge. Maybe they were cutting edge when we started to use them in the early 2000s, but I see advisors, I'd venture to guess 95 to 97% of advisors don't use them, not because they're not great. It's just there's some moving parts and they're not easily marketable, and it's going to hurt them scaling their business, increasing their revenue. But if you've listened to the show, you know that they're a very core component of what we do. We priced a note last week, Bank of Canada, which they really wanted the business over the last couple of weeks, and we were able to get 12.5% annually paid monthly. So take that 12.5% and divide it by 12, and you get those monthly coupon payments. And we were able to get that very, very strong. Again, as a reminder, you get that as long as the indexes, the note tracks, are not down 30%. So each month they just simply look at where the indexes were when the note started, and as long as they're not down 30% from inception, you get paid your 12.5% annualized with monthly coupon payments. So phenomenal strategy, absolutely phenomenal. And I'm just absolutely amazed at the amount of people that are still reaching out, and it really shows the lack of education and the disservice that most advisory firms are doing, because in my opinion, this is as commonplace as a CD. Now, not FDIC insured, of course, but it is backed by the credit of whatever the bank is. And they're relatively short term. We're going to own it for 6 months, and then it's callable every month after that. And so it could be a 6-month investment, could be a 12-month investment. In a catastrophic market, it could be a 5-year investment. But if you're still collecting whatever that annual coupon rate is, 12, 13. This year we've done as high as 15. With JP Morgan, they had a note during April. It's an absolute amazing cash flow generator. And it's something that we talk an awful lot about. So 630-492-1912 if you want to learn more about that. The energy strategy is still great. Picking up some just absolute phenomenal assets. K1s are... they were done, and we had a revision that we had to make, very minor. But again, you have to be correct to the penny with the accountants. But it looks like it will have offset investors' taxable income, capital gains, passive active income by certainly over $90,000 per every $100,000 invested for 2024 investors. So it's been very, very strong. First year we were, let's see here, if we go back, we've been over 90%. We've been mid-80s. Last year, it looks like for Bison 2, it came in over 90%. So if you sold a business, sold a property, have concentrated stock, and you want to, get out of that stock, diversify away from that stock, but minimize the capital gains that you may incur. Again, we're not tax advisors. These are very, very basic tax strategies. But most investors, certainly here in the Midwest, I don't know of another advisor that is going to bring you a institutional strategy like this that is going to reduce your taxable income and have a targeted return within 3 to 5 years of 2 to 1 on your money at $60 oil. So maybe 5%, maybe 10% of your portfolio, maybe 15%. But when you look at tax reduction, if you've listened to the show in the past, you know that I think the most overlooked area of financial planning is tax reduction. I see it far too much. Individuals who have, multiple IRAs that are 1, 2, 3, 4, 5, 6 million, and they don't understand because their advisor hasn't done a tax plan that models out to age 95 what the tax bill, I should say tax bomb rather, is going to be on those RMDs when the government tells you that you need to start taking that money out. And we have to address that now, at least check that box. And so the energy strategy, not only is it diversified, not only are the returns independent of the S&P 500, and I think most people would absolutely love those returns that we target in the energy fund, but the tax benefits are significant. So best practice, obviously, always reach out to your tax professional. Because, again, we can't provide tax advice. However, these strategies have been in the tax code forever. As you know, we started to talk about Bison Alpha. That is our hedge fund that we are launching for individuals. Really phenomenal strategy, we believe. Again, what got us to launch that was, these are, a core component of how we manage personal assets, investable assets, personal strategies, family strategies, money that, unfortunately, there's a difference between how advisors manage their own money and how they manage investors' money. And it's really simply because individuals who manage, when you manage your own money, it's hard to scale those types of strategies into a business, into a strategy that's going to produce revenue for the firm, for the company. So that's why we created Bison Alpha. It's, again, something that we're incredibly excited about. Can't really quote performance because it is a new fund, but we can certainly go over what it is, what it's not, what we're doing, how we're doing it, and look at just some general track records, just some data that I think it'll give you an idea of the type of returns that we're expecting. Again, everything we're doing, just like the structured notes, family office, institutional type strategy, even though that one is the most basic. Bison 2, again, most individuals, unless you want to write a $5 million check and which private equity fund to get to, which you wouldn't be able to find them just because they're not mass marketed. But again, we're bringing institutional strategies to the individual. And then Bison Alpha in that strategy, again, institutional type of a strategy for the individual investor. That is more for your kind of growth plus type money. So we would be comfortable with an allocation of anywhere from 10 to 20% of your portfolio in that. But those are the things that we're doing, and we'll get to after the break the radio show that I listened to and kind of why I think the financial advice radio show market is really nothing more than just pure marketing propaganda rather than education. So 630-492-1912. Give Paige a call, 630-492-1912. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, founder and president of Kuhn Capital Partners. We're independent. We're a fiduciary, SEC-registered investment advisory firm. Our focus has always been tax reduction strategies that can deliver positive returns in negative markets to a point. Strategies, I think when you look at how do you craft a portfolio, I think you need protected growth. And again, protected growth is not, in my opinion, just a bond portfolio. If you look at what bonds have done, you look at the AGG, seriously, pull up AGG on your phone, your computer, wherever you're at. Look at the 5-year return of AGG. That's your safe money. That's your safe money that the average advisor is benchmarking your safe money to. And look at how much you are giving up in potential gains. And it's just unfortunate. But we want protected growth. We want growth. We want growth plus, and we want alternative private equity tax reduction. When you have a portfolio like that that covers and checks all of those boxes, and you know you're with a advisory firm that is very, very forward-thinking, very proactive, very planning-based, that is what we do. We'll model out through our financial planning process a financial plan that's going to truly blow you away. It's a financial plan that will be as granular as you could want it to be, or as high level as what you can want it to be. The plan is the plan. It's just to what level do you want us to get into it with you. We'll model out your tax situation to age 95 for every single client, every single potential client. And that's the first thing we're going to do. And our investment in meeting with you, whether it's on Zoom or in the office, which is what we prefer, is really giving that plan to you. And if you take that plan and you go implement it somewhere else, or you implement it on your own, so be it. I mean, that's perfectly fine. We certainly think that's a mistake, but we are not an advisory practice that has to try to convince individuals to work with us. When you look at our product set, when you look at what we're doing, when you look at the uniqueness of what we're doing, it speaks for itself. And but in meeting with us, you're definitely going to at least get that plan. So 630-492-1912, 630-492-1912. The bank notes, again, as I mentioned in segment one, price a note last week. Bank of Canada, this one was 12.5%. Had, the domestic banks, the UBSs, Morgan Stanleys, Chases of the world were not quite up to the 12.5% when we got the pricing back. So, as you know, we price banknotes most of the time weekly. Really, we look at rates daily, but we do look at pricing and buying a note for all of our clients, generally on a 7 to 10 day kind of rolling period. So 630-492-1912 if you want to learn more about that strategy. Again, really simple, double-digit returns as long as the market's indexes that note tracks are not down 30%. So yes, you can still make money in negative markets. Those strategies do exist. You just have to have the right ones. Past performance and anything that I talk about is not indicative of future results. So as I mentioned, I was in Florida. I turned on the radio show. We were on that station actually in the past, and I think we're going to try to get back on that station, Florida Man Radio. I really loved it actually. And I listened to a financial talk show, and it was just shocking to me what a sales pitch it was. I mean, just absolutely shocking to me when you look at and listen to these radio shows that sell these annuities and talk about absolutely no downside and all the upside of the market, and you don't have to ever worry about losing money in these types of investments. It's no wonder that so many people buy these because of how they're explained, how they're sold, and how they, unfortunately, advisors conveniently leave out kind of the reality of these types of investments. And if you talk to us in the protected growth bucket, you know that we have a 5-year strategy that is an indexed annuity. You don't need to use it. We like it as a complement to what the banknotes are doing. But the difference is it's tied to the S&P 500. And currently it's a very simplistic investment. In my opinion, it's a structured note wrapped. Well, it is really offered by an insurance company, at least the inner workings and the components of how they hedge and whatnot. But yeah, it's very simplistic. You get, the first 10.75% currently of the S&P on an annual basis, it's your calendar year. So whenever you start it, they look at it a year from now, and yeah, your downside is 100% limited to zero. So if the markets are down, your return is zero, and you get from 0 to 10.75% of the S&P. And when you get a gain, that gain's locked in. It is a very, very compelling story for some safe money. The challenge is most of these advisors are looking at, these 10-year, 15-year type of annuities that are indexed to hypothetical indexes that are new that never, ever deliver returns. And again, you have to, as an advisor, you have to, in my opinion, always talk and explain the pros and the cons and be completely transparent. I see far too many advisors showing these lifetime income strategies that I know for a fact that what is illustrated in the real returns of those indexes that industry or that company is using are night and day. They're not accurate because so many of these indexes are new, 1 year old, 2 years old, 3 years old, that they're using hypothetical data. And that is a very, very big problem because when you look at what it has done in the real world, and we can show you third-party sites that we have access to that will show you your illustration says 10% annualized with no risk. But in reality, the last 3 years, it's negative or it's grown at 1%. So I listen to these financial talk shows, and it's nothing more than a sales pitch. And that is so frustrating to me. And this guy's pitch was awful. I mean, not even good. And I just can't imagine holding myself out as a financial fiduciary professional that manages significant amounts of money and not talking about, we want protected growth. We like protected growth. If we're going to use that annuity, there's a lot of people out there that would like that annuity that's 5 years in duration, and people will know for your safe money that you can't lose money in a given year, and you get the first 10.75% of the S&P. Yes, that is a very compelling story for some money. But you have too many of these advisors selling these annuities as equity replacements because that's what the illustration says. And then when the client, 1 year, 3 years, 5 years out has, nowhere near that growth, it's an issue. And unfortunately, it's just an issue. And I don't understand how anybody can hold themselves out as a true fiduciary and not talk about tax reduction. Not talk about strategies that can greatly reduce your taxable income, active or passive. In 24, it was almost $95,000 per $100,000 invested in Bison II. That's our energy strategy. I don't know how any fiduciary or financial so-called professional on the radio cannot talk about, the banknotes on how here's a way to make double-digit returns as long as the indexes don't go down 30%. That pairs very, very nicely with the principal protection strategy that we use. And then, again, you look at our growth bucket. Our growth bucket, institutional manager, oddly enough, out of Chicago. Not that that means anything. But again, when we look at that strategy, significant outperformance of the S&P 500. So this whole adage of you can't outperform the S&P, most don't, because most advisors simply use an index-based strategy that's wrapped up as proprietary and slap a fee on it, and then you underperform the indexes. And so our growth bucket, we'll put that up against anybody. It's our all-cap focused growth strategy. And you look at those returns, even though they're past performance, and it doesn't mean anything about the return tomorrow. They are verifiable. They are real. It's not back-tested. It goes all the way back, many years. And you can see just how important a 1 to 1.5 to 2% outperformance of the S&P over 15, 20, 30 years can be. I mean, that is meaningful. I don't know how anybody, holds himself out as a financial fiduciary on the radio and doesn't talk about, incorporating strategies like we talked about earlier in Bison Alpha, a strategy that, for your more aggressive money, maybe 5, maybe 10% of your portfolio, but have that in a strategy that, we're investing directly alongside of you in strategies that we invest our personal capital in. And again, there's a difference between losing your money, even as an advisor, and losing other people's money. The industry, unfortunately, I think is broken. I think people look at firms, they want to be with firms that manage $15 billion, $20 billion, $30 billion. Good luck with that, because you have an index-based strategy, in my opinion, and you hope to outperform an index, and it just doesn't happen. So those are the things that we're doing. I think when you can bring that and that message in those strategies and that uniqueness of increased cash flow, which is what most people want, rather than that 4% rule, which is so dated. Look at where money market rates are today. I mean, I still can't believe people quote that strategy. It's mind-boggling. But those are the things you want, coupled with incredibly proactive financial planning. then we're going to be a good fit for you. So 630-492-1912, 630-492-1912. More after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm. And yes, we are a fiduciary. We are headquartered out of Oak Brook, Illinois. If you're listening to the podcast in other areas, know that we can work with you. We do have more of a national client base. Our focus is tax reduction. Our focus is strategies that can deliver positive returns in negative markets like the bank notes. Priced one last week, 12.5%. As long as the indexes did not drop 30%, you still received your annualized growth of 12.5%. Paid monthly, not 12.5% a month, obviously, even though that would be too good to be true. But 12.5% annualized paid monthly with 30% downside tax reduction. Our Bison Alpha is launching. That's the fund that we've created to allow investors for your more growth plus type money to invest directly alongside us in strategies that we invest personal capital in, strategies that we look at, and just kind of a very unique, different philosophy for some aggressive money. So 630-492-1912, 630-492-1912. Give Paige a call, set up your initial consultation, whether it's in person, whether it's on Zoom, whether it's a conference call. It doesn't matter. Just give us a call and get on our calendar, and we would love to have that conversation. So a lot of trending topics recently. I love AI. I don't know if you guys use ChatGPT or Grok or what you use, but you can type in things that, my goodness, it's like if you look at the Bison 2 energy strategy, and as you know, that strategy last year, if you were an investor, you received significant tax benefits, active or passive tax reduction of almost $95,000 per $100,000 invested. So think about the Roth conversions that you could incorporate. I see far too many people with these large IRAs, $500,000, $2 million, $5 million. If your advisor hasn't run out a tax strategy to age 95, you may end up paying the IRS just more money than you could ever imagine. You could easily be in the highest income tax bracket just because you have to take out RMDs. So we want to make sure that, we're having those conversations. But these trending topics, I think, that AI is providing are just absolutely phenomenal. And what you can learn has been great as well. In the energy strategy, we're buying non-operated working interest investing directly alongside of the Conocos, Chevrons, Exxons, Matadors, Vaqueros, what we call, the best, well, at least it's our belief, the industry best. Just Google, well, don't even Google, put in ChatGPT, hey, explain to me what a non-operated working interest is alongside the majors, and it's going to tell you. And if that piques an interest, give us a call, because if you want tax reduction, that is a massive ace in the hole that we have. That I don't care if you have 10 million, 15 million, 20 million, 3 million, 2 million, your advisor is not bringing you that tax strategy. They are not bringing you that tax strategy. What they're bringing to you is, unfortunately, tax loss harvesting, which I wouldn't even consider to be. It's certainly a tax strategy. Can't say it's not, but proactive. Yeah, I guess it is proactive too. Cutting edge, hardly. I think that should just be par for the course. But if that's what you want to learn more about, please give us a call, 630-492-1912. We're seeing a lot of topics on the 60-40 portfolio. That's your balanced portfolio, right? Unfortunately, balanced, in my opinion, means lazy. Balanced, in my opinion, means your advisor is not bringing any value to the table. They're bringing value probably in that they're helping you craft a portfolio, but it's nothing that you can't do, and you're going to pay a fee for that. But when you look at what the 60-40 portfolio is, I just think it's failing people. I think the traditional retirement model is failing. We have clients that, have retired this year, that retired last year, that had money in their 401k, and they were told they were doing it right. We're closer to retirement. Now's the time that we, put more money in bonds, and we use these target date funds that shift from equities to fixed income. Never mind that you may live 20 to 30 years and inflation is ripping, and your purchasing power, if you do that, is, just going to be decimated. But that's besides the point. But they lost money. They lost money in the bond market, the bond strategies, the bond allocation, and don't believe me, just pull up AGG over the last 5 years. Do benchmark it to the S&P so you can see what the total return is, positive or negative, and you'll see. But when you compare 2022 to 2024 data showing how the diversified portfolios most advisors are likely building, it's barely moving the needle on the fixed income side, or even worse, losing money. And so if your advisor is talking about balanced, if they're talking about equity to bond allocations, then you're just with an advisor that is using stale and dated, strategies. You want to be with an advisor that's going to use alternatives, the bank notes. I cannot tell you how much money we have raised and new client money that have come to us because of those bank notes this year. I would have never imagined it because the banknote strategy is so basic. It's so basic. But when you tell investors that, we're pricing, these enhanced income yield banknotes that are 11.5, 12, 13, 14%, 15% even in April, that are backed by, the JP Morgan, Citigroups, Bank of America's, UBS, Morgan Stanley's, the largest financial institutions of the world. It's strong. And then when you can tell them that they're going to get paid that cash flow, that distribution, that interest payment, call it what you want, as long as the indexes aren't down 30%, that brings a level of comfort to individuals that unfortunately most advisors aren't doing. And they're relatively short term. We're going to own them for 6 months, worst case, and then they're callable every month after that. As soon as the markets get back to where the indexes get back to where they were when we started, the note's called. So we do another one. That's why most advisors don't do them. They're incredibly labor intensive for the advisory firm. Not for you. For you, they're simple. But for the advisory firm, they are very, very labor intensive. And that's why most advisors aren't doing them. And there is some moving parts. It's simple. But we created a video that my 12-year-old, after she watches it, can understand what it is. It's very simplistic investment strategy. 630-492-1912, 630-492-1912. And I think, we want to plug people into our quantitative approach. And we want to plug people into our quantitative approach, especially with your growth money. When we look at buy and hold, again, buy and hold works until it doesn't. We're not against it, but what's the sell side of it? How do you keep these gains? That's the philosophy here, right? Isn't that what individuals do, advisors do with their own money? You think they just buy a 60-40 portfolio and never manage it? I guess there are advisors out there that do that, but those are ones you certainly don't want to work with, in my opinion. And we're still seeing advisors that are utilizing, mutual funds. We call it the mutual fund museum, and it's unfortunate. And a lot of times, it's the $500,000 to seven-figure to multi-seven-figure investors that still have mutual funds. Lack of transparency, lack of fee consciousness, in my opinion. Certainly not, tax efficient. Why would people in today's day and age still use mutual funds? I do not understand it. I guess if your account's smaller, maybe that's still a good way to get, a diversified allocation. But again, the lack of transparency is 100% there. Most mutual funds, or all mutual funds rather, probably 98% have to stay fully invested. Think about that. They have to stay fully invested. And these are things that don't matter when the markets are going up 20, 30, 40%. I get it. They fall on deaf ears. Been in this industry 25, 27 years. I've dealt with thousands of clients and advisors. And so I understand this. But it will matter at some point. And if you're at the wrong point when we see a down market and you're close to retirement or in retirement, it can be, I don't want to say catastrophic, but it can be very unnecessary. But most mutual funds, and these are things I don't even talk about just because I've forgotten about it because it's so basic. But yet I have to understand that most people don't understand this because they haven't been told this. They've been told that all you do is buy the market, buy the market, buy the market, buy the market, set it, forget it, don't ever touch it. Okay, great. That's a strategy. What if the markets are down? What if the markets are down longer than you anticipate? Go back to 2000, Microsoft. If you bought Microsoft in 2000, 14 years to get back to even. 14 years to get back to even. So most mutual funds, almost all, have to stay 97, 95% fully invested at all times. All times. So they literally could have tomorrow's newspaper, no, the market's going to drop 40%, but they have to keep your money fully invested. I don't get it. And that's a big issue. And I think we have to be brutally honest that most portfolios are built to track the market and they charge fees for that privilege. They're built to track the market and then you pay a fee on top of that. Well, guess what? You're going to underperform. Why are you working with an advisor that does that? If you're working with an advisor that simply wants to have a closet index fund strategy, no tax benefits, no ability to make money when the tax strategies, rather, to greatly reduce your taxable income. They want, strategies that can deliver positive returns in negative markets, strategies that are quantitative in nature that can play offense and can play defense. Those are the strategies you want. Why work with an advisor that simply wants to, dress something up as proprietary, as cutting edge, but yet it's just an index fund. And that's when we do our portfolio stress testing. It's not my software. It's 100% objective, 100% objective. That report, our portfolio stress test, I don't know what we could charge, probably $1,000 a report. And maybe I should charge it, but we don't. And it'll tell you exactly what you own today. And it will benchmark it to what and how it would have performed in 60 to 70 different economic events, from good times to bad times, more than you can imagine. And then you can see for yourself if your portfolio is, really created to stand the test of down markets. Not only down markets, but how much of the upside are you capturing? Because if we go back to that 60-40 balanced portfolio, yeah, your equities are doing well, but they're being drugged down by the fixed income bucket because it's negative. What about just doing a simple swap for bonds for the banknotes? What would that do to your performance of your portfolio? Think about that. What would that do when you could have an investment that can return 12, 13, 14% as long as the indexes aren't down 30% and it's backed by the largest banks? What would that do to your portfolio? So those are the things that we're talking about. We're going to talk about the retirement tax bomb. I know that's a interesting headline, but we're going to talk about that after the break. So 630-492-1912, 630-492-1912.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. I feel like I've been all over the place, this radio show. But that's how my mind works, and you know that. But people like that, I think, because this radio show isn't for my agenda. Does it help us grow our business, and do we benefit from it? Well, without a doubt, 100%. But we're not here just to pitch, an annuity that is going to disappoint you. We're not here to, pitch a single strategy and wrap it up as a financial planning show. We're talking about ideas that are real, ideas that are cutting edge, ideas that you may hire us to manage just our new fund, the Bison Alpha Fund, that is incorporating the strategies and investments that we use for our personal money. Now we're able to do it at scale. You might hire us just to run the Bison 2 energy strategy to reduce your taxable income. You may just work with us just for the banknotes, or you may work with us to manage the whole thing. It really is irrelevant to me. It's never my agenda. It's always the agenda of the client. That's what our radio show is. That's what our investment talk show is. That is what we are doing that is uniquely different. And we're going to take this and we're going to expand it greatly because people need our help. And with the markets doing what the markets are doing, people better be ready for a dip. they better be ready for a dip. We're not calling for it. It's not saying that that's our base case, but the balanced portfolios that advisors are using, you're giving up so much return. Yeah, your equities are doing phenomenal, but you probably have 20 to 40% of your portfolio that is flat to negative or annualizing at under 2% over a 10-year period because of the bond bucket. Just consider this. Consider taking the bond money and incorporating the bank notes. Think what that would do just for your portfolio, the return to your portfolio. When you can get a double-digit return offered by the largest banks in the world, as long as the indexes don't drop 30% that investment is tied to. I just need people to hear me on that, and they are. I wish I would have talked about it sooner because it's helping people, and that's all we care about. So 630-492-1912, 630-492-1912. Start thinking about taxes now. Really, you want to start thinking about tax planning in Q1 and Q2. Unfortunately, human nature, I know people don't start thinking about tax planning, tax reduction for the calendar year because you've made too much money or you've had some sort of a liquidity event during the year, whether you sold a property, sold a business, et cetera, and you have a large tax bill coming. Everyone starts thinking about it in December, and I don't know what the average advisor does. I really don't know, other than charitable remainder stuff where you give away money. And you do get tax benefits, but I don't know what the average advisor does. And what we do for our high wage earners or for those who want to do Roth conversions and minimize the additional income tax is to utilize Bison 2, our energy strategy. If you're an investor in 2024, you reduced your taxable active income, passive active income by almost $95,000 per $100,000 invested. Again, we're not tax professionals. But these strategies have been in the tax code forever. And it's always best practice to reach out to your tax professional, of course. But think about that. You want to do Roth conversions and minimize that income tax? Let us show you how to do it. You have a multiple seven-figure IRA, and you don't think that you can do Roth conversions because you make too much money? Okay, fine. But let's talk about how Bison 2 and those tax benefits can help you convert while minimizing that taxable income. I mean, there is a retirement tax bomb on the table for people who have larger IRAs, and it can become a disaster. Now, let paying taxes be your worst problem. I mean, that, as my partner Brian, will always tell you. But let's plan for it. Let's minimize it. And I'm just so surprised that advisors don't have any tax planning software. I mean, our tax planning software, which it really just gives us a full look through of your tax life. You send us your tax returns, and we upload it on an annual basis, and we're able to look at how much we can convert. We can look at before we bump you to another tax bracket. We can look at, it's just basic stuff. Most of the big firms don't even let their advisors use that software, which is just shocking to me. But most people don't understand if you have even a $500,000 IRA, and it just gets worse when it's $2 to $3 to $4 to $5 million IRAs or 401ks. The government is going to come and collect their money. It's called RMDs. When you have to start withdrawing money, even if you don't need it, and you have a larger IRA, you may be in the highest tax bracket just taking those distributions. Tack on Social Security, tack on any other passive income or active income that you have, you could be paying more in taxes than you paid while you were working. That is a reality. And when we do our financial plan, which is what we do for every single client, every single person that meets with us, that's our gift to you. That's what we give to you. Work with us, don't work with us, you're getting the plan. And we're going to model out to age 95 what we would, and again, you have to put an assumed growth rate on it because we don't know the future. We use a very conservative assumed growth rate at 7%. And we'll show you every single year, if you lived to age 95, what your tax bill would be, what your RMD would be. And then we have to start to address that now. Now is the time we start to address it. So, we're coming into, we're in third quarter, but, we're coming into, August, September, October, November, December, where people start to think about taxes. We don't want to wait until November, December, especially in the energy fund, because every asset that we buy in the energy strategy, the seller, they know that come November, December, they don't need to negotiate on deals because everybody needs a deal. So we're trying to change that industry of tax reduction, that we want people to think about it as a year-round activity. So, when we look at the tax strategies, it's a huge mistake that retirees or those that are, have larger IRAs are making. They're deferring too much. And it's a great thing because your money grows tax deferred. But you may be shocked what you have to pay in taxes. The old adage of I'm not working, so I'm going to be in the lowest tax bracket. Well, not if you have a meaningful IRA, you're not going to be. And let us show you that. And if Advisor isn't doing that, shame on them. And but good for us. So we're going to talk a whole lot next week. 3 things investors must do if you have 1 to 10 million, what you must do by the end of the year. We'll talk a little bit about one of the topics now. You have to run a Roth conversion analysis. And if you have 1 to 10 million in an IRA, you're probably a higher wage earner. So you may think that a Roth isn't for you. Well, it probably isn't unless you have a tax strategy like we do in the energy space, that you can pair a conversion with an investment of taxable dollars into the energy strategy. Well, how does that work? Well, I convert simple math, $100,000 from an IRA to a Roth. It's $100,000 of additional taxable income. Well, let's say you took $125,000 of taxable money and invested it in the energy strategy, and you had a tax benefit last year of, well, if you did $125,000, you were close to, let's just call it $120,000 tax loss. So think about that. You convert $100,000 of taxable income additional, invest $125,000 in the energy strategy, you had $120,000 tax benefit. So in essence, you did the Roth conversion and you didn't increase your taxable income. Those are the things that we are talking about that differentiate us. So if you have $1 to $10 million in your IRA, you have to do a Roth conversion analysis. It's time. It's time to evaluate tax-efficient alternative investments. It's time to stress test your portfolio against market risk and against rate risk, interest rate risk. It's time. And we're going to do that for you. That's something that we give away complimentary. And it is so reassuring for individuals to be able to take their current portfolio. That's the biggest hangup, is how do you get us the holdings? Even if you send us your portfolio statement, there's absolutely nothing we can do with it. Even if you had the account numbers on there, absolutely positively nothing we can do with it. So I don't care how you get us the data. Email it, upload it to our secure site, spreadsheet it, tell our assistants on the phone. We don't care. Get us what you own, and we'll run that portfolio stress test, and we'll stress test it against 70 different economic events that have happened in the past, and we'll show you how your portfolio held up, how much money it made, and we'll benchmark it to the indexes. And then you'll be able to see if you're working with a proactive, cutting-edge risk manager. That's what we are, risk managers. So with that, I want to thank everybody for listening to the show. 3 out of 5 people that reach out to us per show are going to reach out for the bank notes. We're still looking at over 12%, at least last week. So 12% with 30% downside. That is just absolutely phenomenal cash flow. And heck, great return. So consider comparing that to your bond funds. Your bond funds, if you're managing the money on your own, or the bond strategies that your advisors are using, compare them to the bank notes, and I think you'll be pleasantly surprised. So with that being said, reach out to Paige. Hopefully everybody has a great week. We look forward to some exciting announcements of what we're doing with the radio show. And we do podcast every radio show and kind of where we're taking this because the response has just been too good. So we want to share the love, share the wealth, share the knowledge with as many people as we can. So give Paige a call, 630-492-1912, 630-492-1912. Make it a great week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.